As someone with Dutch heritage, the story of tulip mania is more than just a historical footnote for me. In the 1630s, the Netherlands saw people trading their homes, businesses, and life savings for a single flower bulb. Why? Because they believed in the illusion of a permanent increase in value. They thought the value of these flowers could only go up over time. And when I look at the market today, sitting at all-time highs, I see a parallel of that same sentiment. This isn't in some fringe, speculative asset class, but in the core of many successful people and business owners' portfolios. The biggest risk for many today isn't chasing a bubble. It's being complacent sitting in one. Now let me be clear. This is not a video about timing the market or predicting a crash. I wholeheartedly believe in the long-term power of investing in the market. But the lesson from the Amsterdam tulip auctions is that any asset, even one with broad appeal, can become overvalued. When everyone owns the same thing and believes in the same story, the risk isn't in the asset itself. It's in the concentration of perceived value. If you're a business owner or successful professional, you've likely benefited from this incredible market run, even if only through a workplace retirement plan. Your net worth on paper has probably never been higher. So the critical question now is not should I get out, but rather is my wealth structured to survive a shift in sentiment? We're going to use the two biggest mistakes from the tulip craze to answer that question. And the solution may be simpler than you think. Let's look at the two lessons from the 1630s that are essential for protecting wealth in 2025. In Holland, the single story was tulips are the ultimate status symbol, and their value will continue to rise forever. Everyone from global merchants to maids piled into this one asset class. When the bottom finally fell out, their entire financial world collapsed because they had no alternatives. Today, the single story for many investors is US large cap stocks are the safest game in town. Many people I speak with have 80, 90%, or even more of their invested wealth tied to a handful of tech giants. They have become completely dependent on one story, one asset class, and one country's market, continuing its historic outperformance. The solution to this is strategic diversification. And I don't mean buying a stock in a few companies you've personally never heard of. I mean true diversification across asset classes that behave differently in different economic environments. Stocks, bonds, real estate, possibly even alternative asset classes if it fits within your investment objectives. To bring it back to this story, if the Dutch tulip investors have also owned shares of, say, the Dutch Indian Trading Company or property in Amsterdam, the crash would have been a more manageable loss, not a catastrophe. The most expensive tulips, like the famous Semper Augustus, were traded frenetically in taverns. But by this point, people weren't investing. They were gambling. They were trying to pick one bulb that would make them rich, buying on hype and selling on panic. This is the classic mistake of trying to outsmart the market. The modern, disciplined response to this is passive indexing. Instead of trying to find the one Semper Augustus of stocks, you're systematically buying a small piece of the entire garden. Passive indexing is a strategy of humility. It admits that you can't consistently predict which stock or even which sector will be the winner. So you buy large swaths of the market without needing to constantly track hundreds of tickers. This removes emotion and the temptation to chase performance, which is what got the tulip speculators into trouble. So what's the lesson from my Dutch ancestors? It's not to be afraid of investing or shy away from markets at all-time highs. It's to be smart. It's to build a financial foundation that doesn't rely on a single story or your ability to predict the future. By combining strategic diversification across different asset types with the disciplined, low-cost approach of passive indexing within those asset classes, you create a portfolio that's resilient by design. You're prepared for any season, whether the tulips are blooming or not. If your portfolio success had been riding heavily on the current market conditions, it might be time for a structural review. Let's conduct a deep dive analysis of your holdings to ensure you're not overly concentrated and that your wealth is positioned for durability. Click the link in the description to schedule a complimentary strategy call with me. It's a no-pressure conversation to see if your strategy aligns with your long-term goals. Thank you for watching. Subscribe for more strategies to help you build and protect your wealth. I'll see you next time.